We are talking 203k's.
You know that very specific sinking feeling you get when you walk into your own house? Or maybe you're scrolling through listings on a Sunday morning and you just start squinting at the screen.
The squint, oh, I know it well. It's the visual equivalent of trying to make the math work in your head.
Exactly. You're looking at a kitchen that just screams 1985. You see those laminate countertops peeling at the corners, appliances that rattle when you walk by them, or
Oh, don't say it.
that weird fuzzy carpet in the bathroom. Which, seriously, can we just agree? That was a crime against hygiene.
It was a different time. We made some questionable choices.
Clearly. But you have this internal monologue. You think, I love this neighborhood, I love the school district, I love the bones of this place, but I hate this stuff.
Mm-hmm.
And then immediately after that, I want to fix it, thought, reality hits you like a brick wall.
The how do I pay for it wall.
Right. Because unless you're sitting on a pile of cash, which, let's be honest, most of us aren't, you're stuck. Do you drain your emergency fund? Max out a credit card at what, 22% interest?
Or do you just resign yourself to living with the avocado green bathtub until you eventually move?
That is the classic homeowner's dilemma.
It is. Most people view a house as this static object. You buy it, you live in it, maybe you paint the walls, pay the mortgage, but they miss a massive financial blind spot. Savvy real estate investors, they don't look at what a house is worth today.
They look at what it will be worth.
Exactly.
And that is the core of our deep dive today. We're unpacking a stack of research on a government program with a terribly boring name, the 203k Rehabilitation Mortgage Insurance Program.
It sounds like a tax form you'd want to hide from.
It really does.
Yeah.
But based on these sources, it's actually a financial power tool. It's essentially a time machine for your equity. It lets you borrow against the future value of your home to pay for renovations today.
That's a great way to frame it. It unlocks equity that doesn't technically exist yet. But you're right, it is a power tool. And like any power tool, you need to know how to use it safely or you can lose a finger.
Good.
Before we get to the 203k, which is really this advanced maneuver here, we need to map out the landscape.
Right. Because if you're a homeowner right now and you want a new kitchen, you usually hear about two main options, the HELOC and the home equity loan.
The big three, if you count the 203k.
Yeah.
But options 1 and 2 are what 90% of people use. We need to understand why those work and, crucially, where they fail to see why the 203k is so special.
So let's start with option 1, the HELOC. I feel like just get a ELOC is the standard advice you hear at every backyard barbecue.
It is.
But how does it actually function under the hood?
Right, so HELOC stands for Home Equity Line of Credit. The best mental model for this is a giant credit card that is secured by your house.
Okay.
It utilizes the gap between what you currently owe on your mortgage and what your home is currently worth.
Okay, so let's do the math on that. If my house appraises for, say, $400,000 and I still owe $200,000, I have $200,000 equity, can I swipe for that whole amount?
Not usually, no. Banks are conservative. They'll typically let you borrow up to 80 or 85% of the home's total value minus what you owe. So in your example, you might have access to maybe $100,000, $120,000.
Still a decent chunk of change for a renovation.
It is. And the defining feature of the HELOC is flexibility. You have a limit, say $50,000. If you only use $10,000 to fix the roof,
You only pay interest on that $10,000,
exactly. You don't pay interest on the money you haven't touched. It's on demand.
which is great for cash flow. You're not paying for money you don't need yet.
Correct. And often during the draw period, usually the first 10 years, you might have interest-only payments, which keeps the monthly bill artificially low.
But there has to be a catch. Banks aren't exactly known for their generosity.
The catch is the rate. HELOCs almost always have variable interest rates. They are tied to the prime rate.
So if the Fed wakes up tomorrow and decides to raise rates to fight inflation, my kitchen renovation just got more expensive.
Your monthly payment goes up. Even if your balance stays the same, that uncertainty can be incredibly stressful for people on a fixed budget.
Yeah.
But there's a bigger trap here, one that our sources really emphasized. It's the liability trap.
I saw this in the notes. This is about the psychology of spending the money, right?
Precisely. Because a HELOC feels like free money or house money, people often use it to buy things that lose value. A boat, a luxury vacation, a new car. The source was very blunt about this. A liability takes money out of your pocket.
And since your house is the collateral.
If you lose your job and can't make the payments on that boat you bought with your house money, the bank can foreclose on your home. You are literally risking your shelter to buy a toy.
That's a sobering reality check. The bank technically owns the house until that deed is clear.
Okay, so that's the HELOC. Flexible but variable rates and dangerous if you lack discipline. What's option 2?
Option 2 is the home equity loan. This is often called a second mortgage.
How is that practically different from the line of credit? It's all about the structure. Unlike the line of credit, this is a lump sum. You go to the bank, they hand you a check for $50,000.
And you start paying on the whole 50 grand immediately.
Immediately. Principal and interest, whether you've spent it or not.
So less flexibility. Why would anyone choose that over the HELOC?
Stability. These usually have fixed interest rates. Your payment is the same every single month for 10, 15, or 20 years. If you're the type of person who needs to know exactly what your bill will be to sleep at night, this is the better option.
Right.
It's great for a single large expense where you have a contractor's quote and you know the exact price.
But there's a risk here too related to market values, isn't there?
Yes. This is where we have to look at history. Think back to 2008. The source material referenced the movie The Big Short, which is perfect context. If you take out a huge second mortgage, and then property values take a nosedive.
You end up underwater.
Exactly. You owe more on the two loans combined than the house is worth. If you need to sell for a job transfer or divorce, you can't. You'd have to bring a check to the closing table just to get out of the house. You're trapped.
So let's summarize. Option 1 and option 2 both rely on one crucial thing. You must have equity in the house right now.
Correct. The bank is lending against what is already there.
But here's the scenario that drives people crazy. What if you just bought the house and haven't built up equity yet? Or what if the house is a total dump, a real fixer-upper, and isn't worth enough yet to give you the equity you need to fix it?
That is the wall most people hit. I need money to fix the house to make it valuable, but the house isn't valuable enough to get the money.
It's a classic catch-22.
Until you bring in option 3, the FHA 203k. This is the loop breaker.
Okay, so how is this fundamentally different? Because on the surface, it just sounds like another loan.
It is a loan, but it's an insured loan backed by the Federal Housing Administration. The fundamental difference is that it combines the purchase or refinance of the house and the cost of renovations into a single mortgage.
So one monthly payment.
One payment. You don't have a mortgage bill and then a separate renovation loan bill. But the real magic trick, the thing that makes this a power tool, is how they calculate the borrowing limit. They don't look at the current value.
They look at the after repair value, or ARV.
Exactly.
Okay, let's stop there because this is the aha moment.
Yeah.
You're saying I can borrow money based on a theoretical future. How do they even determine that? It sounds like guessing.
It's not guessing, it's appraisal science. Let's play it out. You find a house in a great neighborhood where homes sell for $400,000. But this specific house is a disaster. It's listed for $250,000.
Okay.
It needs a new roof, a new kitchen, new floors. Let's say $100,000 worth of work.
A traditional bank looks at that and says, we can't lend you $350,000 on a house worth $250,000.
Right. But the 203k lender says, show us the contractor bids. You get detailed quotes for the new roof and the kitchen. They hand those plans to an appraiser, and the appraiser says, okay, once this specific work is done, this house will be worth $400,000.
So they lend you the money based on that future number.
Yes, they lend you the $250,000 to buy it, and they put the $100,000 for construction into a restricted escrow account. You close on the house, you own it, and then the work begins.
That is huge. You're basically creating equity out of thin air.
Or rather, out of vision and paperwork. You're financing the potential. And there are other benefits. Because it's a primary mortgage, the interest on that renovation budget is tax deductible.
Just like regular mortgage interest.
You can't usually say that for credit card debt.
Yeah.
And I also saw a detail in the research that seemed like a lifesaver. What if the renovation is so massive you literally can't live there?
Like they're ripping off the second floor, or the plumbing's disconnected.
This is a fantastic safety feature. If the home is uninhabitable during the work, the 203k allows you to finance up to 6 months of mortgage payments into the loan.
Wait, so the loan pays itself?
For that period, yes. It prevents that nightmare scenario where you're paying rent for a temporary apartment and paying the mortgage on a construction zone. The loan covers the mortgage holding costs while you're displaced.
That solves a huge logistical hurdle. But I have to play the skeptic here. If this is so amazing, Why isn't every single person doing this? Why doesn't every real estate agent push this?
Fair question. There is no free lunch. The cost here is effort and bureaucracy. This is a government-backed program.
Which means paperwork.
Mountains of it. The closing process takes longer, usually 45 to 60 days. And the interest rate and fees are typically a little bit higher, maybe an eighth or a quarter of a point than a standard vanilla mortgage.
Why higher? Just because they can.
It's about risk. The lender is handing you money for a house that isn't finished yet. If you walk away halfway through, they're left with a half-built mess. So you pay a slight premium for them taking on that construction risk.
That makes sense. Now, looking at the HUD specs in our source stack, it seems like the 203k isn't a one-size-fits-all thing. It comes in two flavors.
That's right. You have the limited 203k and the standard 203k.
Let's break those down. What is the limited version for?
Think of the limited as the cosmetic loan. It used to be called the Streamline. It's for minor remodeling and non-structural repairs. We're talking about things that make the house look better or function better, but don't change the footprint.
So new kitchen cabinets, painting, appliances, maybe new windows?
Exactly. But you cannot move load-bearing walls, and there is a cap. HUD guidelines say you can finance up to $75,000 into the mortgage for these repairs. It's designed to be faster.
Faster being a relative term for the government, I assume.
Relative, yes. But you usually don't need a specialized consultant because the work is straightforward.
Okay, so if I want to add a master suite, fix a cracking foundation, or move the kitchen to the other side of the house, I need the heavy artillery, the standard 203k.
Correct. The standard is for the heavy lifting. If you are doing structural work, or if the renovation cost is high, essentially sky's the limit up to the FHA loan cap for your area, you use the standard. You can strip a house down to the studs with this.
But with heavy lifting comes heavy oversight. This brings us to the biggest fear people have with renovations, the contractor nightmare.
Oh, we've all heard the stories.
You pay the guy 20 grand up front because he says he needs materials, he demos your bathroom, leaves a pile of rubble in your hallway, and then stops answering his phone.
It is the #1 anxiety for homeowners, and this is where the standard 203k offers a safety net that simply does not exist with a HELOC. It's called the HUD consultant.
Who is this person? A government official.
They are an independent advisor certified by HUD. For a standard 203k, you are required to hire one. They visit the home before the loan even closes to create a detailed work write-up and cost estimate.
So they check the budget.
They verify that the budget is realistic, sure, but their real value comes during construction. They manage the draw system. This is crucial. In a 203k, the contractor does not get the money up front.
Wait, really? Most contractors want 50% down to start.
Not here. They might get a tiny startup fee, but generally they have to do the work first. The project is broken into phases. Let's say phase 1 is demolition and framing. The contractor does the work, then calls for an inspection.
And the HUD consultant comes out.
Yes. The consultant walks the site. If the work is done and up to code, they sign off on a draw request. Then, and only then, does the lender cut a check. And here is the kicker. It's usually a two-party check.
Made out to both the borrower and the contractor.
You got it.
That gives the homeowner massive leverage. The contractor can't just cash it and run.
Exactly. You have to sign it too. It completely changes the power dynamic. The contractor has to perform to get paid. It forces a level of professionalism that you don't always get with a handshake deal.
That structure alone seems worth the extra paperwork. It takes the trust me factor out of the equation. Now, I want to pivot to strategy. We've talked about how the loan works, but why would you use it? The sources mention two main paths: renovating to live and renovating to sell.
Renovating to live is the lifestyle play. Maybe you love your neighbors, but your house is too small. You use the 203k to add a bedroom or customize the layout for aging in place.
Like moving the laundry to the main floor.
Sure, it saves you the cost and stress of moving. But the renovate to sell strategy, that's where the math gets really fascinating.
This is for people who want to sell but know their house is outdated.
This is a huge opportunity right now. We have an inventory shortage. Buyers are fighting over homes. But, and this is a big, but modern buyers are busy. They want turnkey.
They want to walk in, drop their keys, and live. They don't want to spend their weekends stripping wallpaper.
Exactly. They will pay a premium for convenience. We call it the turnkey premium. If you sell a house as is with the 1970s shag carpet, you attract the sharks, the flippers.
Who want to buy it cheap, do the work, and keep the profit.
Mm-hmm.
So by selling as is, you're leaving money on the table.
A lot of it. But the dilemma is most sellers are house rich and cash poor. They don't have $30,000 cash to fix the place up before listing it.
So how does the financing help here? You can't get a 203K just to sell, can you?
Not exactly. A 203K is for the buyer. However, the source material highlights specialized bridge programs where renovations are done by a company and paid for at settlement.
Let's walk through the profit calculation from the source, because seeing the numbers really clarifies this turnkey premium.
Okay, stick with me. Let's say a homeowner owes $100,000 on their mortgage. The house is tired. If they sell it as is, they might get offers around $160,000.
So they pay off the loan and walk away with $60,000. Not terrible.
It's okay. But let's say they find a way to invest $25,000 into renovations. New paint, floors, modern fixtures. Now the house is turnkey. In this market, that house doesn't just sell for $185,000. It likely sells for $200,000 or even $225,000.
Why the jump?
Because buyers are emotional. They fall in love with the finished product. They get into bidding wars.
Okay, let's run those numbers. $200,000 sale price. You pay off the old $100,000 mortgage. You pay back the $25,000 renovation cost. You're left with $75,000.
Right. You walked away with $15,000 more pure profit. And if the market is hot and it sells for $225,000, that gap widens to $40,000.
That's significant. That's the difference between buying a used sedan or putting a solid down payment on your next home.
It is. It's about forcing appreciation. When you present a finished product, you aren't just selling a structure, you're selling time. And buyers pay for time.
It really changes how you look at a house. It's not just a place to sleep. It's like a bank vault you can unlock if you have the right combination.
That's a great analogy. Renovation financing is the key to that vault. It allows you to stop accepting your current situation as permanent.
So we've covered the big three HELOCs, home equity loans, and the 203K. We've looked at the safety net of the consultant and the math of forcing appreciation. What's the big takeaway for you here?
I think the big takeaway is that a lack of cash shouldn't stop you from improving your living situation. The financial tools exist to bridge the gap between where your house is and where it could be.
It effectively removes the excuse of, I can't afford a new kitchen. You might not be able to afford it with cash in your wallet, but your house might be able to afford it for you.
Precisely. And in a world where housing inventory is low and prices are high, finding a fixer-upper and using a 203K to polish it might be the smartest way to get into a neighborhood you otherwise couldn't afford. You buy the worst house on the best block and you use the future value to turn it into the best house on the block.
I love that. It's about seeing potential where others see problems.
That's the investor mindset.
So here's a thought to leave you with today. We often assume that the only way to upgrade our life is to pack up, sell, and buy a new, bigger house. But what if the upgrade is already sitting under your feet? If you could finance the construction of your dream home inside the shell of your current one, without needing a mountain of cash up front, is the grass really greener on the other side? Or is it greener right where you are once you actually water it?
A fascinating question to consider.
Thanks for diving deep with us today on the 203K. Hopefully your next renovation project feels a little less daunting and a little more like a smart investment. We'll see you on the next deep dive.